Good evening, everybody, and welcome to the 12th edition of our Quarterly Connect webinar. Thank you very much for taking the time to attend this evening. As always, we'd like to thank all our investors for trusting us to manage your wealth and all our distribution partners for the support extended to us over the last several years. This evening, we'll have Prashant Khemka, our founder, provide an update on the portfolio and also the performance. Post the session, we'll have a Q&A. I'll request you to kindly post your questions in the chat box. Over to you, Prashant.
So thank you everyone for joining today. Much appreciate you taking the time on Monday evening. I have with me on the call, and they'll be participating in the Q&A as well, Parag Jariwala and Rohit Choria, whom many of you know would have interacted with you over the course of the years. If I were to go through just quickly, so we've completed during the last quarter, we had we had a major milestone in that we completed 6 years of the launch of first WhiteOak strategy and 5 years of the launch of Pioneer's equity portfolio, since we launched Pioneers a year later in September 2018. What this slide shows is the encapsulates basically the performance of the strategy, as well as so first year or so is the earlier not the earlier strategy, but the India Econ, as it is called, strategy, and since 2018 is the Pioneers strategy. So that's the performance at the bottom of this net performance, net of fees of the portfolio, and that of the benchmark and the alpha over time. So you'll see that since inception, the portfolio performance has been very solid in the top decile. Earlier years, it was like in 2018 at the top of the peer group. So how to read this is basically each bar represents the range of peer group performance. The square or the diamond in the middle is the performance of the benchmark. Green zone is the top quartile performers. Red zone is the bottom quartile performers. So what this means is in 2018, there were here, if you see in 2018, there was a very wide range of fourth quartile performer. Here in 2023, there is a very wide range of top quartile performer. Now, this is usually correlated also with how the SMID caps do. Since 2018, SMID caps did very poorly, and most PMS managers are extremely SMID cap heavy. Hence, the underperformance had a wide range. And this year, because SMID caps have done very well, it is on the other side, a very wide range. So in 2000, hold on just a second, I'll hide my bar. So 2017, 2018, 2019, 2020, and even so these 4 years we were, firmly in the top quartile or second and beating the benchmark, including in 2021. 2022, as we all know, was a challenging year. As benchmark was top quartile, we were in the third quartile, it appears, and year to date, we are more or less in line with the benchmark, a smidgen below. Now, I must highlight that the universe here of peer group is anyone with over 1,500 crores of AUM, and that is flexi cap strategy. Okay. So this does not include mid, SMID, small cap strategies and all, of which there are hundreds of PMSs. This is performance across the various strategies that have 5 years or longer of track record now. So as I was saying, WhiteOak Pioneer launched in September 18, 17.5 portfolio net performance compared to 15, just under 15 of the benchmark, 2.7% net alpha. This places it, as I was sharing earlier, while this is for 6 years, but even on 5 years, it places it firmly in the top quartile. The other strategies, as you can see, have these are the 5-year numbers. So we have the PMS Select Equity Portfolio, which incepted much earlier, November 17. So had the 2017 strong alpha, as well as for the full year, as I was sharing earlier, the performance was very strong at the top of the peer group. So it includes the 2018 alpha as well. And it is a more absolute return oriented 15 name portfolio. So quite a bit different. That one also has a strong now 6 years of track record. And this is AIF. Now, there's a difference when you look at AIF returns. Remember, these are net of taxes, whereas on PMS, those are gross of taxes. So net of taxes, the performance is very solid, outperformance of absolute return of 14.5 and net at 1.7. Year to date, if you see, this is what the numbers look like. You're smidgen behind again, 14.3 compared to 14.6 on the Pioneer net of fees, and on the others, because AIF has a lot more, since it's closed-ended, it has a lot more small and mid-cap names that has done in a market that has rallied very strong in small and mid, that has done better this year. Even net of taxes, it is up 2 point, outperforming by 2.2. This is the journey in a graphical format. So obviously we've had some major events over the last 5 years in the Indian market, the ILFS crisis, the global pandemic, the war, and almost unprecedented rate hikes by the Fed. Through all this, this is indexed to 100, about 23% gross net alpha, 23% net alpha, which annualized is translating to 17.1, 14.9, as we saw earlier. This is the 6 year. So what we saw previously, this is the Pioneers, and this is the 6 year for the strategy, 6 year plus. As you can see here, 160% net return, which is 16.8% annualized, compared to 109% of the benchmark, 12.7 annualized. So cumulative 51% alpha of annualized 4.1. It's been only 6 years, so simple. Obviously, we all well aware of the power of compounding. 51 divided by 6 would provide 8% or so alpha, but due to compounding, the annualized alpha is 4.1%. So very important to really compare on an annualized basis. But this performance, if you'll see, comprises of two halves. The March or August 2017 to March 2020, which is the COVID bottom, where the BSC 500 was down 17%, as you can see here. Our portfolio actually was up 15.6%. So this is cumulative, a cumulative alpha of 32.4%. So when markets over this time period was down, the portfolio was actually up and did very well to generate 32% alpha. Now, since March 2020, there's been a very strong market where market's been up 151%. Our portfolio has been up net 125%, so negative 26% alpha. Now, again, one would, if you're not aware with how the math works, one would think 32 plus, 26 minus, plus 6% alpha only. However, it actually is plus 50 plus 51% alpha, not plus 6. Because alpha generated in down market, this 32% plus alpha is far greater in its weight over time. What this means is dollar for dollar, alpha in down market is far more valuable than alpha in up market. To give you another way of understanding it, if let's say you invest $100 in a fund, the benchmark is 100 as well. Let's say the benchmark goes down to 50 and the portfolio is down only 40%. So then you're left with $60 in the portfolio and $50 in the index, okay, in the index. Now, if you were to, let's say, take the money out here and index it, and let's say the market quadruples. So market 50 goes to 200. This one would go to 240 so you have $40 more or $40 of alpha, if you will. this entire time period. Now, this is on the back of just 10% alpha that was created because the portfolio was down 40 instead of down 50. Now, if you look at this is, let's say, similar. What I'm showing here is similar to this time frame. Yeah, the numbers are different, but it is a down market. Whereas if, let's say, in another instance, if you put $100 in a portfolio where the benchmark doubles to goes to 200, and you generate, say, you go to 240, it would appear to be generating 40% alpha, but actually it is no different. This 40% is no different than this 10%. Because in the end of the day, this has also become 40% alpha. Indexed to 100, a 10% alpha in a down 50 market is the same as 40% alpha in a up 100% market. I know it's a bit confusing, but it is mathematically one of the simplest things, though people generally don't necessarily realize that until you think about it. And that is the reason why you see that our performance cumulative alpha is 51% because of the very strong alpha generated in down market. Historically, over my career, alpha generation has been strong both in down markets as well as in up markets, though in this up market, certainly alpha generation has been weak. Yeah, so just extending a little bit further on these two time periods. Yeah, this is the time period before COVID hit, and this is the time period from the, not before COVID hit, but this is the time period before the market bottom on 23rd March 2020, and this is the period after 23rd March 2020. So if you look at those two time periods, the market environments were quite different. During the first time period, the market was down 11%, whereas the PSU index, this is all annualized, PSU index was down 22%, and large caps were down 10%, and mid caps were down 17%. Yeah. And if you look at during this time, our annualized alpha was 12%. What I showed earlier was obviously cumulative over here. The 32% was cumulative. If you were to annualize that, that was 12%. Very powerful, best performing amongst the peer group. Over the next, since then, time period. So over this time period, the PSUs underperformed the benchmark by 11%, and mid caps also underperformed. But the more powerful factor for us is governance. While PSU is not alone in terms of what is weaker governance, but that is taken as representing weaker governance, if you will. So 11% PSUs underperformed and mid caps underperformed. Now, over the subsequent 3+ years since March 20, you have the BSE 500 up 35% annualized, which is, not many time periods in history where you have a 3.5-year period run of annualized 35% return. PSUs have outperformed materially or substantially over this time period at 43.5% they've compounded. And similarly, mid caps have outperformed large caps. So as you can see, PSUs have outperformed and mid caps have outperformed. Our annualized alpha is minus 3.8%. So plus 12% here, minus 3.8% here. And as a result, overall, it is plus 4.1. I am emphasizing it because if you only focus on our performance during this time period, yeah, when our the PSU style factor, the governance style factor is against us, or not just if you focus on our performance during this time period, but if you focus on anybody, any fund manager's performance, good or bad, yeah, then for over just last 3 years, then you'll get a very skewed picture of only part of the cycle, not the entire cycle. Anyone who has a lot of government-owned companies and mid and small cap government-owned companies would have done phenomenally well over the last 3.5 years, whereas there might have been a disaster over the previous 3 years. And over a full 6 years is what you should compare. I mean, longer 6 years also is still not a historically, cycles have tended to be longer than 6 years. If you think about 92 was a all-time peak of Harshad Mehta bubble, then 2000 was the dot-com bubble, then early 2008 was the GFC top, And then after that, we haven't had a broad-based top like January 2008, but you can think of January 2018 as a top for mid and small caps in India at least. And now we seem to be coming closer to that as January 2018. So we've done a little bit of a comparison with 2000 between 2017 and 23. So if you were to assume a line over here so as to be able to understand, and assume a double line over here to be able to not get confused, this is 2017. Look at what was, I mean, now history never repeats itself, as the saying goes, but it rhymes, right? So what you'll see here is a bit of rhyming. 2017, the best performing index was sector was real estate at 108%. 2023 year to date, the best performing index is again real estate. Yeah, small cap PSUs outperformed the benchmark and outperformed the overall small caps. Not a huge amount, but outperformed nonetheless. 47% is a very strong return in any case. And year to date this year, small cap PSUs have done far better than even 2017. Small cap PSUs are up 76% compared to overall market PSUs up 13. Overall market small caps up 33%. Yeah. PSUs this year themselves have done far better than the market, though that wasn't the case in 2017. So in some ways, actually, obviously there are several differences as well. Like consumer discretionary did very well in 2017. And in aggregate, it has done well this year, but small cap, consumer discretionary small cap did extraordinarily well in 2017, but has underperformed considerably this year. So as I said, not everything is never, two situations, 2 years are never completely alike, but there are some of the similarities that I'm highlighting. So small cap industrial, so it's the infrastructure names, power equipment names, utilities. Utilities is separate. Utilities also did very well. Small cap utilities did very well then and have done very well year to date, outperforming the comparable benchmark. And industrial small cap did very well then. So did overall industrials did very well, and this year also has done very well. So there are several similarities. Basically, domestic cyclicals with weaker governance, if you were to think about, had done fantastically in 2017 and has done even more so this year. Now, I'm not suggesting next year they're going to fall off like 2018, but I do want to highlight 2018 was quite a mirror image of 2017, where, as you can see, real estate was the worst perform or amongst the worst performing sectors. Small cap real estate was certainly the worst performing amongst the small caps. PSU small caps were the second worst performing after real estate small caps. Utilities small caps did very poorly as well, and industrial small cap were amongst the very worst performing as well. Now, we don't know what is there in awaiting us 2024, but what I would like to emphasize is you should not extrapolate what we have experienced in 2022 and 2023 into future. Not that you are doing, but oftentimes if you're not consciously thinking about this, there may be tendency to extrapolate. Yeah, so something to keep in mind. Now, moving to another aspect of our, in the past, a lot of questions have been asked, on single names, individual names in our portfolio, especially the questions center around names that might have underperformed or done poorly. Yeah. Sometimes the questions have been asked also, how many of the names that you bought historically have outperformed versus those that have underperformed? So we asked our team to do the analysis. And what you see here is that over the last 6 years, since inception, yeah, we have owned 178 different stocks in our portfolio, including at different times bought, exited, and all that. Of these, 113 or 64% have outperformed. Yeah. And the remaining 64 stocks, so one of them is zero, and 64 stocks have underperformed. So nearly twice as many, or 64% having outperformed. It is a fantastic strike rate. I think globally, the strike rate is well below 50% because globally the average manager underperforms. Now, in India, the average manager has outperformed, so the strike rate is likely to be better. But I would be very surprised if there are many out there whose strike rate is more than 64% because there are not many out there who have outperformed us over the 6 year period in an all cap or a flexi cap construct that I'm talking about. Yeah. So this is something I wanted to particularly highlight here is Zomato, because a year ago, 2 years ago, a lot of you probably asked about the name. Now the stock is back to, I think, making money in since the IPO. At that time, just like, and that's no different than how a lot of people out there right now are asking a lot of fund managers about Honasa. Now we haven't invested, at least in the PMS, in Honasa, but yes, WhiteOak has in some parts of the firm, has invested in Honasa, and there are a lot of questions about Honasa single name. Um, um, as of today, at least Honasa is also in the money, but I'm just saying, focusing on a single name without having context of the overall portfolio and without having the context that any manager anywhere in the world, would have in the portfolio stocks that would do poorly, and singling out one or two stocks is not a productive or an exercise that is going to provide any insights. Yeah. In fact, in Zomato, we lost a sum total of 12 basis points. And this is in the India econ strategy. My belief is in PMS, we lost about 5 to 6 basis points only. 5 to 6 basis points, not percentage points, but basis points. Whereas InfoEdge, as against the 12 basis points of loss in Zomato, we've gained since inception. InfoEdge has been our second best performing contributing stock to the portfolio since inception, contributing 750 basis points. Now, InfoEdge is also a new age company. So is Zomato. By the way, InfoEdge, one of the key reasons, rationale for investing in InfoEdge at the time was Zomato, because Zomato contributes, InfoEdge was the largest shareholder of Zomato. Zomato being an investee company in InfoEdge. The market at back then in 2017, 18, 19 time period, when we had bought InfoEdge and had owned it in a very large position size, the market was hardly giving any value for Zomato because the business model was not something that at least the investors in India understood. It was loss making at the time. Anyways, so there was always pressure on InfoEdge management that would you invest more money in Zomato? Hope you would not invest more money in Zomato. However, having invested in similar companies outside India in emerging markets, um, uh, and not just myself, but the analyst covering the stock at the time as well, having invested outside India as well, to us, Zomato was a highly valuable gem in the InfoEdge portfolio that was being underappreciated. And if you provide an appropriate valuation of Zomato to InfoEdge business was uh, uh, drastically undervalued, hugely undervalued, and hence InfoEdge was one of the top names in the portfolio. So we have in fact made more money out of Zomato, I would say, than anybody else out there. And yet, a lot of questions were being pressed on Zomato a year or two ago. So I just thought once we did this analysis, something to share with you and highlight the futility of just, excessive focus on one name, because there's no portfolio out there that doesn't have underperformers. Yeah, it's just like in banks. The best of the banks have NPAs. This is something our financial team put together. Over the last 10 years, system level NPA has been 7.2%. And a 10-year average ROE of the system banking system has been 5.6%. These are the various banks and non-banking financial services companies as well, and their 10-year average NPAs. The same has been plotted over here as well, the average NPAs. And at the top is the 10-year average ROE. So on the left side box, we have listed them by size more or less. But here on the right side, it is from highest ROE to lowest ROE. Now, the best of the banks and the best of the NBFC do have some NPAs. Yes, there may be less than others, just like our rate of mistakes, I believe, is far lower at about 36% compared to the peer group, though there is no way for us to compare it with the peer group. Similarly, the best have the lowest NPLs, but it is non-zero. Yeah, the average for the system is 7, and these guys have the average, the 7 equivalent in portfolio management, you can think of it as 50%. Yeah, compared to 7, these banks have done 1.1, and that differentiates them vastly from the from something like these other banks. And hence, if you look at the ROEs of these compared to this, also I would highlight here, while I'm on this, that it's not necessary that the lowest NPL, which is HDFC, would have the highest ROE. In fact, Cholamandalam, which has more than 3 times as many NPL, has delivered higher ROE over a 10-year period. So it is also possible that you can have a higher percentage of stocks making that have gone wrong, and yet you may have higher alpha than someone who has made lower mistake. It all depends on how right you are when you go right. So if you look at our highest alpha is 7, even 900 basis points from one stock, yeah, and then this is 750, and then there are several between 500 to 600 and so on. We should have calculated the average. I don't have the average handy, but it would be fairly solid, about 300 basis points or so. I will check. I don't know, because there's a lot of small ones, so maybe the average is more like 200 basis points or something. But here the worst alpha is more like a little over 300, and then quickly falls down to 200 and so on. So it's also the magnitude. If you make mistakes, several mistakes, but those mistakes are small, like Zomato, minus 12 basis points, whereas when you get it right, you get it right big, like InfoEdge plus 750 basis points, then you can afford to make more mistakes and yet generate higher return, just like Cholamandalam seems to have done, even with 3.7 of average NPA, has generated 18.3%, and sizable if you were to think of average ROE as the benchmark return, and Chola's generated nearly 13% ROE alpha, if you will. Obviously, that's compared to a lower GNP, but even compared to HDFC, despite 3 times the mistakes, they've generated some alpha over HDFC. I'm going to quickly now move to the quarterly performance. Quarterly was a tough quarter for the strategy, as a lot of the things that I pointed out related to PSU were in full force in third quarter. Year to date, the strategy is, as of today, more like flat, as if you were to include November. This is as of October end. If you look at, this is since inception, but I'm going to skip these numbers. So just since inception, some of the names that have done very well. This is a 5-year inception, yeah, and that's why InfoEdge is appearing here over a 5-year period, because a lot of the InfoEdge returns might have been in the first year. But Coforge, Naveen, and so on and so forth, as you have seen before, and these are the detractors, Indigo, Delta, and so on. If I were to look at last quarter, the top contributors and detractors, so top detractor was Nestle, wasn't down much, but in a strong market, down 1.7%. So the market overall was up, as you can see, 5.5% in the quarter. And so down 1.7% also contributed minus 30 basis points. Naveen Fluorine had a change of resignation of CEO MD and hence took a hit. So that one was the only stock really that was down double digit. Others were Info Edge, we were just talking about, has been a star performer over the last 5-6 period, but last quarter has detracted from performance. On the positive side, not a surprise, government-owned BEML is at the top of the pack. BEML is something we bought towards the end of 21, more as a risk mitigation effort because PSUs were doing so well and we didn't have any PSUs. So some risk mitigation, as you know, we always uh, uh, incorporate in our, the team always incorporates in their approach. So that last quarter did very well and contributed positively. And another industrial CG Power Systems have done very well. Also a healthcare name doing very well. Portfolio composition as of now that the team has looks like this, consistent with the past. There's nothing that we find attractive in energy and utilities. Otherwise, the portfolio is very well allocated across sectors. Financials in absolute terms continue to be the highest exposure, very good exposure to allocation to consumer and industrials as well. As you might recollect from prior quarterly connect calls, we have added to quite a few industrials. Also, they partly act as a good hedge against the under allocation to PSUs and the domestic cyclicals in general. Healthcare always tends to be a good allocation in the portfolio as well. From a market cap weight perspective, the team is somewhat wary of the runaway valuations in some pockets of small cap. Small cap structurally would always be overweight, but at this point in time, I think the team's overweight to small and mid cap is somewhat towards the lower end. So mid cap plus small cap is 42% of the portfolio. Now, in absolute terms, it's not much different from the around 40% that the team has always had. But in the benchmark, the weight of mid and small has increased because they've done much better than large cap. So in the benchmark, it's about 26% now, mid and small. So in the portfolio, it is 42. So the overweight that the team has is only 16%. Historically, this has tended to be 20, approximately 20% is the average. It's not that it's never been as low as 16. It has been sometimes even lower than 16. But want to highlight that the team does find that the valuations in several pockets of small caps are ahead of fundamentals. And while on the other hand, certainly there are many, it's a, you can't generalize that. There are many small caps where the valuations are still very attractive, but just the opportunity set is somewhat smaller than historically. In terms of other aspects, if I were to, these are the stocks that the team has bought year to date. In industrials, ABB, Hindustan Aeronautics in their OFS, again a PSU and also an industrial. TCS has been, the team has switched from Infosys to TCS over this time. Mankind Pharma at the time of the listing, and then Sonata Software is another IT services besides TCS that the team has bought. And then these are the names that have been exited year to date. If there are questions, we can maybe Rohit or Parag can address on these individual names. But otherwise, these are the. I just want to share a couple of other slides on the macro. So, earnings growth have been very strong over the last 3 years, 20%. From the COVID year, it accelerated and has been 20% as profit cycle is improving. This is corporate profits as a percentage of GDP. Many people suggest this is as an important indicator of earnings acceleration, but it's always only visible in hindsight. Over the previous 12 years, we had very mediocre earnings growth of 5% despite solid GDP growth because corporate profitability declined from 7.3% to 1.5%. Yeah, but now it is on the rise. The average is about 4%. We are more or less about average. pendulum can swing on the other side as it usually does. These are the calendar or fiscal year numbers. So fiscal year 21, 14%, followed by 33 and 13, and now projected to be, this year is on track to be about mid-teens, and projections are for similar numbers. Yeah. Globally, amongst the global peer group, India is the second strongest earnings growth expectation over the next couple of years. Valuation is a bit in the no man's land, while it feels like, so in small caps, it's a different, is at all-time high in absolute index terms, and even overall the index is closer to all-time high. But because earnings growth, indexes would always be hitting all-time highs. Indexes have been hitting all-time highs for the last forever. Yeah, at least that's been my observation in an inflationary and strong growth country like India. Currently, it's at 18.2 times compared to Modi era average of 20.7 times. So it's trading at about 2.5 multiple points lower compared to the last 10-year average. So about 12% lower than the last 10-year average. The very long-term average is about 17.2 times. So compared to that, it's trading at about 5% premium, because under Modi, the market has been trading at about 15 to 20% premium compared to its historical average. Now, compared to emerging markets, Indian market is trading at 2 standard deviation above its historical average. But that's primarily because China has derated substantially, and that's more of a structural derating in our view. But relative to its own history, India is, in fact, as you can see, more or less in the reasonable zone, depending on what time frame you choose. We're going to skip a lot of these, which we have discussed in the past. I want to just talk about the inflows, as it seems to be of great interest to investors, even though we don't find it of much relevance beyond a point or much relevance in stock investing at all. But yeah, it does. If you look at the underlying, the domestic inflows have been predominantly in small and mid cap, at least in the mutual fund world, which is somewhat corroborating the hyper rise, or nearly 50 from the March 28 bottom. Small caps are up more than 50%. Yeah, just over September, October, in an 8-month period, small caps are up more than 50%, whereas overall market is up closer to 25%. So very massive outperformance, and partly contributing to that, only in part, might be this heavy inflow into SMID. While we have not broken it down here, but disproportionately large share of this number in some quarters, more than 2/3 of the inflow has gone into small and mid cap mutual funds. Yeah, foreign inflows is at $12 billion, neither very strong nor weak. Put together, there's been about $27 billion, but it's fairly healthy, one of the highest historically in terms of inflows in the market. What is helping also is this steady inflow through SIP, which also tend to be more biased towards small and mid cap. As you can, $2 billion a month now, which is 25 billion annualized inflow in the mutual fund world. This one shows the SMID cap premium or discount. This is across countries, but let's focus more on India. The peak in 2017, which was a multi-year or over a decade peak of SMID cap premium versus large cap, was 26%. Presently, we are at this is 19.9, which is 20%, getting close to what was a decadal high in terms of SMID cap premium. So I would say having some caution towards small caps would be very warranted, at least not to go headlong into small cap funds or the hottest segments of small cap market would be prudent. Yeah, just like if you see the similarity, 2013 was a multi-year low for mid caps. In absolute terms, also, I'm saying, while this is for and having experienced it, June, July, August of 2013 was a multi-year low. I would say after March of 2003, it was and obviously for a brief period in 2008, post the global financial crisis, 2013 was a very difficult to live through mid cap low. From there, the Modi rally in mid caps started. Of rally, when I say outperformance of mid caps compared to large caps, and that went on from August 13 to Jan 18 for 4.5 years. During this time period, many of you might remember, most of the PMSs which invested in mid caps, small caps, and mid caps did phenomenally well. But then it unraveled quite sharply from Jan 18 till end of 19, but you can take it, let's say, till March 2020. Over this 2-year period, a lot of mid cap PMSs vanished. The fund managers shut down the shop because performance was horrendous, giving back all the gains of this time period and a lot more. Yeah. And then from here, if you see, the mid caps have more or less done with some ups and downs. Like even here, there were some ups and downs. This period was challenging for mid cap relative to large cap. Similarly, you had a bit of a relative underperformance, but pretty much you'll see this 3.5-year period where the relative premium has gone from minus 15% to now plus 20%. So I'm going to pause here, not going to belabor on the India's macro environment, as you're very well aware, and open it up for questions, turning it back to you, Vivek.
Thanks. Thank you, Prashant. Just to remind all our investors, you can please ask your questions by typing in the chat box at the bottom of your screen. So Prashant, maybe we'll start off with a question which is there from an investor on the renewable sector. What are the thoughts? And given that we've not yet invested in stocks, what are your thoughts on that particular sector or related to that sector?
Certainly. So see, renewable is a reality globally. There'll be massive growth in renewables everywhere around the world, including in India. So all those numbers are out there. The government has put targets of so many gigawatts from renewable. REC, Power Finance, REC on their call announced that they want to grow their portfolio to renewable sector from 30,000 crores to 3 lakh crores, a 10-fold jump in their lending to renewable segment between now and 2030. Just in 7 years, 10-fold in 7 years means you're doubling every 2 years. Yeah, and doubling every 2 years means 40% plus CAGR. So REC, and same is true for other lenders also, plus or minus that kind of growth is what the renewable energy sector is expected to have going forward. Now, doesn't necessarily mean that the renewable energy companies would be the best beneficiaries or would be the best investment opportunities in the food chain, because you have to look at what are the, just like during the infrastructure boom of 2003 to 2010 or something, the infrastructure companies did not end up being the best investment. Or let's say the road construction boom. So neither all the road construction companies more or less of that time have disappeared, more or less all the companies, and the road construction or asset owners have not necessarily been the best of the um, uh, investments in the value chain of the road construction. But you have to look at where in the value chain might the profit pool be lasting profit pool, and where valuations are not adequately capturing that. So in our portfolio, while we may not have a direct renewable energy company, we do have, as we saw earlier, ABB is a name that we added at the beginning of the year, uh, which is obviously they are at the heart of the energy infrastructure, the power infrastructure, and the utility infrastructure, and they would remain at the not just in India but globally, and they would be at the heart of this energy transition from conventional uh, energy to renewable. Similarly, Crompton CG Power uh, again is a major beneficiary of the same um, transition. So we do have these and other companies as well who benefit to different degrees uh, from the big transition over the coming, and we'll have more companies in down the line as well that benefit from this. Obviously, Larsen and Toubro is in the portfolio, which also has considerable exposure uh, to this area, though much less so than ABB CG Power.
Sure. Thanks, Prashant. So maybe Rohit, over to you. There's some questions on names such as InfoEdge and Zomato. So maybe you could just give an overall thoughts on new age businesses at this time, and maybe if you want to comment on these names.
So yeah, I mean, there's no broad brush. These are all very different companies, but at a very broader level, what we have seen through this funding winter, quote unquote, for new age companies, I think uh, some companies will come out stronger out of this. And these are companies which will share some of these characteristics, right? One, a more established business model. I mean, having already probably gone into positive unit economics or being close to it. Number one. Number two, companies that have used this quote unquote funding winter, right, to work on their cost structures, profitability, and just execute it better. uh, Number three, companies that have no funding constraints in terms of having a stronger balance sheet than the peers in their respective industries, right, or sub industries, right? Because such phases then lead to market share gains which can be sustained, right? We are seeing this in a lot of consumer tech and fintech segments where some companies are now starting to gain significant market share. So these three or four characteristics, and there are companies, and lastly, I think while through this, companies that have maintained or added to their consumer franchise, and there are names that have done, all of this, sit on strong balance sheets. The business model is reasonably well established. They are reasonably close to positive unit economics or are already there, and these names are going to stand out. And what has happened through this funding winter is competition in some of these subsegments has gone down because the quote unquote cheap money or free money is no longer available, and that has meant some consolidation as well. Yeah, so there are names like Zomato, Nykaa. Some of them in their respective categories are starting to stand out, and these are the names that could benefit from this phase we have seen in the new age tech space. Parag, if you want to add anything on the fintech side.
No, I think fintech also, we always been very mindful of the fact that there has to be a core competency in terms of generating the loan, right? I think having a wide customer base, plus the kind of customer base who are ready to pay 2, 3, 4% extra money for you to generate loans. Plus, they should also have the database or can say some bit of underwriting model where they can cherry pick their customers, maybe from the CIBIL score or kind of transaction they do, kind of balance they keep. So combination of all these things can only drive long term return. Otherwise, most of the fintechs which we have seen are either just a payment gateway where it is very difficult to make money because government or RBI has made it free. So I think these three characteristics will drive the growth for any player, which are concentrating on these three aspects.
Thanks, Parag. Parag, just take it. But before that, Prashant, may I request you to just stop the screen sharing? I think it's just.
Sure, sure.
Thank you, Prashant. Yeah, so Parag, staying with you, there's a question on the recent RBI circular which has raised the risk weight on consumer credit. Just
Yeah.
what are your thoughts on that, and how do you think that unfolding?
Yeah, I think that is most debatable and hotly discussed topic in the banking sector currently. See, look what RBI has done. RBI has increased the risk weight on certain category of loans which are unsecured and given to consumers or for consumption purpose and not for the business purpose. Now, if you look at the all other kind of loans, whether it is auto loan, housing loans, loan against property which are for business purpose, or normal loans which are given for business purpose, are already out. So while calculating the impact, we have to be mindful that there is only a portion, maybe it is 18-20% of the entire banking or a system credit, which will see an increase in the risk weight. Now, the second part is that, when the risk weight is increased, in our assessment, can it have an implication for industry growth? Maybe yes, around 1-2% softness in the industry growth you may see. But then let's go specific to the companies which are impacted. So if you look at our companies or companies where we have our investments, all of them without exception are very, very well capitalized, right? So when you increase the risk weight, there is absolutely no implication on the overall credit, and they may even gain market share versus others, and possibly there will not be any implications for their loan growth. So yeah, I mean, to summarize, industry wide you may see some softness, but I think our coverage universe are very comfortable on capital, and they may even gain some bit of market share versus competition because of this circular.
And I may just add, Parag, as we were discussing the other day, you
Yeah.
shouldn't just on the negative side that it would slow down the growth a little bit. There's a positive side as well. It reduces the risk. One of the concerns that our team and the industry, a lot of industry investors in the industry was also having is this rapid growth in unsecured loans. Can it down the line uh, create risk in the system that becomes unmanageable? So
Yeah.
it's good that this RBI action may, to some degree, blunt at the edges some of that rapid growth. So that's the positive on the positive side of this. So if the growth rate slows down in this retail unsecured loan segment from say 30-40% to say 20-25%. Yeah, now this retail unsecured loan is probably a single digit in the system, right, Parag?
Yes.
Yeah. So let's call it, I don't know the exact number, but 8%. If it 8% of the portfolio slows down by 10% on the growth, that's a 0.8%, call it 1% reduction in the overall credit growth. But if that results in a far safer um, or more prudent lending, and as a result, healthier balance sheet at an aggregate level for the banking system, that's much better. You anyways any day take that.
Sure. Thank you, Prashant. Prashant, there's a question for you now. You mentioned that there are some pockets, especially small cap, which are now ahead of fundamentals. The question is around whether you're looking to trim any weight in the mid caps in the portfolio.
So I think Parag, Rohit, and the team has been trimming selectively, from what I understand. And maybe I can turn it over to. I don't think it is actually advisable to discuss individual names on a broad forum like this. But from what I have observed, and Parag and Rohit, you can correct me if I'm wrong, that there have been trims that the team has taken where we find that like in sectors like defense, manufacturing, power, otherwise deep cyclicals, where we anyways have fairly limited exposure. But even within that, where we find that the fundamentals, while solid, the valuations are running ahead, the team has taken appropriate trims over there. And in any case, we don't, I mean, with some exceptions like, BEML that you saw, and Hindustan Aeronautics is more of a large cap, but we don't, fortunately or unfortunately, we don't have much exposure to like PSU small caps, which we saw is up 75% year to date after a very strong last year. So there isn't, much, unfortunately, to trim at this point in time in that segment, if I'm correct, Rohit and Parag. So if those segments were to do poorly, I think the portfolio would be in very good shape on relative terms, just as it was in 2018 was the best year of my career. And for the team, I would say the best year till late in 2018 in terms of relative performance, at least, when everyone else in the market had, a lot of pain.
Sure. So, Prashant, there's another question one of our investors wrote to us, and we get this quite often, is on the disclosure of the portfolio. Here at WhiteOak, we have a lag for our AIFs, which is usually 1 month, and for the PMS as well. Just your thoughts around why we don't declare the portfolio real time. That just help in that.
I would, if it was actually up to me, and in some of the international markets, we don't disclose our portfolio at all. Yeah, we don't want competition or others particularly competition, to analyze what we might be buying. Yeah, because there are many people out there who want to analyze what fund managers are buying, and then they take actions that benefit them but could be at the detriment of the fund. Yeah, so it is in the interest of investors, at large, that we as a policy like to not have public disclosure of what we have. The other managers who keep trumpeting what they own and what they've just bought, but we like to try and keep a low profile on that one, though we have to disclose as per what is regulatory requirements, and where the regulatory requirements require us to disclose, we do. But we do only at the time frames that the regulations require. I hope that answers the question, Vivek. Bottom line, it is in the interest of the investors to not for it not to be public knowledge.
Certainly, Prashant. Thank you. There's a question on the tax. Maybe I can address that. The returns of the AIF is net of realized capital gains taxes and expenses. It does not take into account the unrealized gains, but every AIF pays taxes for each financial year. So all the AIFs are, as of today, net of taxes as of April 2023. So it's taxes paid up till then. It's only this year, if any unrealized gains, taxes are not accrued in the NAV. So we're at the hour now, and I think we've gone through most of the questions. There are some questions which are specific single or individual names, which I think it's best we do it separately. And I reach out to the.
Vivek, I don't know what we decided last time based on in feedback. Do we want to cut off at 1 hour or 1 hour 15 minutes? Otherwise, we can do a rapid fire.
Yeah, I think 1 hour is what we decided, and we are at the hour. And I've kind of combined most of the questions to address them. There are a few which are on select names in the portfolio. Unless you want to address them, Prashant, maybe you could do that.
So I think I'm just looking through here, and you're right that yeah, there's a question about whether FII flows returning back can help large caps. Yes, it is possible. Look, when there's massive inflows from domestic market, it does tend to go more towards mid and small cap, and where there's massive inflows on the FII front, it does, but it does evolve over time. And just because of inflows, it is not necessary that you can draw the conclusion of one segment. In the aftermath, you can analyze. Sometimes there's barely any difference. Sometimes there can be more. So it's not something that you can make money out of, is what I'm saying. But yes, if there is a large FII inflow, not of the magnitude that has been here so far, but multiple times, then yes, it is possible that they often tend to go towards the larger cap. Then there is a specific question about CG Industrial, which I would likely not address, like to not address here in this forum. It's a company, it's done very well for us over the last year or two. Any individual quarter can be here or there. Any few days can be here or there in the stock price. Then I think we covered. Hold on a second. Yeah, there's a question about WhiteOak. AIF has underperformed its peers in the industry with similar strategy. Could you explain? So I think we already went over the performance. The longer term performance is very strong. And we went over the last 2-3 years performance of the reasons. And particularly if there are AIFs which have lot larger exposure to, so there may be flexi cap, but there may be a flexi cap which like ours has 45%. In AIF, we have 45 to 50% in mid and small, call it close to 50%. But there may be flexi cap AIFs which have 70 to 80% in mid and small cap. Yeah. And so if in a year like this year, if you have 70 to 80% in mid and small cap, it will be very difficult to outperform if you for someone with 50% in mid and small cap. And particularly if that 70-80% in mid and small cap is in likes of PSUs and the real estates and whatnot, as we discussed earlier, it would be more difficult. But if a year like this which is very similar to 2017, if a year like this is followed by a year like 2018, as I was showing, then it within matter of days, the picture can turn completely upside down in terms of relative rankings. So that's what I would recap based on what we already discussed. I think there are some single stock questions related to InfoEdge and Zomato, which to the extent we could discuss, Rohit has already discussed. There's a question about view on data center companies. There aren't too many in India which are focused on the typical data center operations. We do have, like they are in US, which set up large data centers and rent out space and whatnot. We do own some companies in the portfolio which could be provider of products. Like even ABB has a business that's growing very rapidly, where they provide products, connectivity products and power equipment to data centers and benefits from the rapid growth in there. And then there are other companies similarly in the portfolio who have part of their business coming from that segment, but not that we have a huge exposure necessarily to data center. There aren't many companies, good companies at least, that are there in that segment. Then we talked about the financial sector weight in light of RBI and all that. As there was something that is related to Tube Investment, who are doing law. Do you think the positives they are financial? Yeah, so just to correct on Tube Investment, the venture into it remains to be seen. Yeah, it is a position in the portfolio. They've already been hugely successful with CG Power. So CG Power they invested in as well 3, 4, 5 years ago. I think they will be making several such investments. We are not counting on each one of those being successful. We are we do believe Valiant is a extremely good leader and builds very strong management teams that have created value in Cholamandalam Finance, which has been one of our top holdings in some time and a top performer as well, and CG Power. EV, electric vehicles, they've got into more recently, just I don't know the exact time frame, but more maybe a couple of years back, and not really 10 years back, and it is still very early days. They haven't really failed yet. They have attracted some private equity investment in that business as well at a fairly healthy valuation, but operationally it remains to be seen how it plays out. It's very early days, and so far the progress has been decent and good. How does the team view the current high premium on SMID caps? We already talked about that. Disclosures of NAV and portfolio, we talked about that. And there is a specific question on InfoEdge that's very specific on their cash flows. We can talk about that separately. If I think we've covered InfoEdge at considerable length right now. Yes, they would have. They had a write-off of some 270 crores or something, as is mentioned here. I don't remember the precise number, but as I said, every fund manager, there is no fund manager on the surface of the earth that doesn't have mistakes in the portfolio. And Info Edge has this investee company portfolio, which is where they made these huge profitable investments like Zomato and Policy Bazaar and several others. Yeah. So a 270 crore write-off in that context is not even peanuts, I would say. They have made 20-30,000 crores of profits. So 270 crores would be like profits in the sense capital gains. Yeah. So 270 crores, maybe it's a little bit excessive to say not even peanuts, but you have to keep it in context. It's 1% of the capital gains that they would have made in their investing company. So we should not get, again, as I was talking about earlier, we should not get fixated by one or two or a few mistakes of any investor or fund manager, and look at in broader context how they've done over time. And InfoEdge management has done fabulously well. There's no comparable in terms of how well they've done in the Indian market in their success in the investee companies. When are you planning to launch an app? I'm not sure, Vivek, if you have a answer to that. Total PMS AIF AUM. What is the total PMS AIF AUM, Vivek?
About 13,500 crores.
13,500 crores. Okay. How do you see the revival of in the next 36 months time frame? Again, future look, we can talk about the past, share the track record, how the performance has been generated. And obviously, we expect future to be just as good as the past, if not better. But any particular time frame, short time frame, is hard to say. Short or medium term is hard to say. Yeah, and while 36 months looks like a long time frame, typical market cycles are in India, as I was sharing earlier, 7 to 8 years. We are 6 years now, and 6 years has been very strong. And who knows, sometimes cycles can be shorter, sometimes cycles can be longer. Over cycles, I expect the team to generate outstanding peer group leading performance. So finally, an investor has asked why we invest in high valuation IPO like Mamaearth. So just to clarify, we have the mutual fund side. They might have invested in, first of all, they might have invested in Mamaearth. Here on the PMS AIFs, we have not, correct me, Rohit and Parag, if I'm mistaken. So on the PMS AIF side, we have not invested. Having said that, we are not saying that Mamaearth is a mistake. Oftentimes, this hype media, social media thing is created around a certain stock, positive or negative. Nobody then does a reconciliation historically of historical mistakes and all. Yeah, if you go back historically also, a lot of people would have written a lot of negative about a lot of different names which have gone on to do extremely well. Yeah, including if you think of Zomato, I don't know what the IPO price was, Rohit. There's all kinds of
76. 76.
76. And what was Damodaran's valuation on it? 30?
He started with 35, then
35.
down to 30.
Yeah. So people would cite this, that, and the other smart person's view on a particular name. All these things, see, first of all, we don't know whether Mamaearth is a mistake. Yeah. And secondly, bear in mind, there would be individual mistakes in anybody's portfolios. That is what makes the market. And as to why we invest, we can put you in touch with our mutual fund guys who feel that it was a attractively valued IPO. To me, I'm not close, and I don't know whether Rohit or Parag are, but in any case, this is not a forum for that detailed a discussion. Only time will tell whether Mamaearth turns out to be right or wrong. My point is, even if it is wrong, we are in the business of making calculated decisions. If we only go by what is regarded as very good investment on social media and by investors at large, then we are not really needed by you all, right? You can do that yourself, or anyone can do it by surfing the social media. So we would at times make investment decisions which may look in the what is it called, public wisdom, or in the wisdom of the crowd, not to make sense, but collectively you'll have to see how the the outcomes are over time. So I think we covered everything. We didn't. Oh, sorry, there is
One more question just coming, Prashant.
what's your view on bearing manufacturing companies? So I have, over the last 15 years, often invested in bearing manufacturing companies. They're great franchises, if you will. They are very strong, like Schaeffler, SKF, Timken. There's some very strong competitive advantages. However, having said that, the valuations have the two things to keep in mind. In the electric vehicle world, the number of bearings required would be drastically lower. I don't know. I think some figure, and I'm a very good friend in the bearings business, so I get to, a little bit more knowledge on bearing sector than maybe some of the other auto ancillary sectors. But something like 80% less bearings or something would be required. Yeah, 70-80% less bearings for some of the uh, 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 electric vehicles. Obviously, the per bearing value would be higher, but the number of bearings would go down dramatically. Now, that may not be a problem in railways and industrial bearings and so on, but that is one of the things that one needs to keep in mind. Yeah. Secondly, the valuation. These companies are trading at very hefty valuations now, and so you have to look at compare whether these are somewhat auto ang / industrial companies. For the fundamentals that are there for these companies, the valuations that they are trading at now, whether there are other places in industrials and auto auxiliaries that provide better opportunity to create value. And so at this time, we do think that to be the case. We have evaluated very closely. The team has evaluated Timken very closely. There was, I think, a OFS or something as well. And we evaluated very closely Schaeffler and SKF, like the business, but the valuations are very rich. And some of these, less so for Timken and Schaeffler, and maybe a little bit more for SKF, the exposure to auto bearings is very, very large. And some of that would be at risk in the EV world, though we expect them to transition well, but still remains a risk. Any plans to look at the unlisted space? No, in PMS, you cannot invest really in unlisted space. And even in AIF, you have a 3 to 5 year kind of closed-ended fund. Yeah. If you invest in unlisted space and if the company doesn't list within that window, then just it is an operational nightmare. So for the PMS AIF, we are unlikely to invest in the unlisted space. We've covered this time, except for the individual stock questions, everything. So I want to thank everyone. Vivek, any last closing comment you have, or Rohit or Parag, unless you have? We can thank the investors. We've gone 15 minutes over, but at least we've covered everything.
Yeah, thank you all.
Thank you.
Thank you. Thank you all for taking time Monday evening to join us. Much appreciate. Look forward to the next time.